In 1978, if you had told any economist in the world that within 40 years, a single country would lift 800 million people out of poverty, grow its economy 60 times over, become the world's largest manufacturer, build the longest high-speed rail network in human history, and fundamentally change the price of almost everything you buy, they would have told you that was economically impossible. Not unlikely, not ambitious, impossible. And yet, every single one of those things happened. And they happened in a country that in 1978 had an economy smaller than Italy, where the average citizen earned less than $1 a day, where food was rationed by the government, and where private business was essentially illegal. That country is China. And whether you know it or not, what happened there over the last 4 decades has shaped your finances more directly than almost any other event in modern economic history. It changed what things cost in your store. It changed your job market. It changed your investment returns. It changed the political landscape of your country. And it is still changing all of those things right now. So let us understand it properly, not with headlines or politics, with economics. To appreciate how extraordinary China's transformation was, you need to sit with the starting point for a moment. In 1978, China had just emerged from a decade-long cultural revolution, a period of deliberate political upheaval that shut down universities, persecuted academics, and systematically destroyed the country's intellectual infrastructure. The economy was centrally planned and deeply inefficient. The government decided what was produced, who produced it, where it could be sold, and at what price. There was no stock market. There was almost no private sector. And the country's total economic output, adjusted for today's dollars, was roughly $300 billion. For a country of nearly 1 billion people, that is an extraordinarily small number. Then, at the end of 1978, a man named Deng Xiaoping took power, and he made a decision that defied everything his party had spent 30 years saying it stood for. He decided to let the market in. Not fully, not freely, but strategically, carefully, and in a way that no country had ever tried before. He called it socialism with Chinese characteristics. The simplest way to understand what that actually means is this. Imagine a country that kept tight political control at the top, but allowed economic competition, private profit, and foreign investment to operate underneath that control. The first move was creating special economic zones, specific designated areas along China's southern coast, particularly in the Guangdong province, where foreign companies were allowed to come in, invest money, hire Chinese workers, and build factories. This was revolutionary in context. For a country that had treated foreign investment as ideological contamination, it was an enormous shift. Companies from Hong Kong, Japan, Taiwan, and then the United States and Europe arrived. They brought capital. They brought technology. They brought manufacturing expertise. And they found something that at that moment in history existed almost nowhere else: a massive pool of available workers, a government eager to grow, and labor costs dramatically lower than anywhere in the developed world. Here is the part that most people miss about this period. The arrangement was not simply that foreign companies moved factories to take advantage of cheap wages. The Chinese government built a specific condition into these partnerships. If you wanted access to the Chinese consumer market, which meant access to over 1 billion potential customers, you had to partner with a Chinese state enterprise. And those partnerships came with a quiet but powerful requirement: transfer your technology, your processes, your manufacturing knowledge to the Chinese partner. Company after company accepted this because the market opportunity seemed too large to pass up. And through those agreements, Chinese manufacturers did not just assemble foreign-designed products. They learned how to make them. They absorbed the engineering. They mastered the supply chains. They understood the quality controls. China was quietly building industrial knowledge at a scale and speed that had never been attempted before. By the mid-1990s, the results of this knowledge accumulation became visible through a single phrase that entered global business vocabulary: the China price. This was the cost at which Chinese manufacturers could produce goods. And it was not 10 or 20% cheaper than Western alternatives. In many product categories, it was 50, 60, or 70% cheaper. Think about what that means in practice. A factory worker in the United States in 1995 might earn $15 an hour. A factory worker in China might earn 15 cents. Even accounting for lower productivity and shipping costs, the competitive math was simply impossible for Western manufacturers to answer. Textiles, electronics, steel, furniture, automotive components, toy manufacturing. One by one, industries that had been the economic foundation of Western working-class communities became uncompetitive against the China price. Between 1980 and 2020, China's economy grew at an average annual rate of approximately 9.5%. Most healthy Western economies grow at 2 to 3% per year. China sustained nearly 4 times the Western growth rate for 40 consecutive years. In dollar terms, its GDP went from $300 billion in 1980 to over $17 trillion by 2023. That is an increase of nearly 60 times in 4 decades. And in the same period, the share of China's population living in extreme poverty, defined as under $2 a day, fell from approximately 88% to less than 1%. 800 million people in 40 years. The largest poverty reduction in human history by a very significant margin. 4 specific mechanisms drove this growth. The first was manufacturing exports. China becoming the factory for the rest of the world and generating enormous foreign currency earnings in the process. The second was infrastructure investment on an extraordinary scale. Between 1990 and 2020, China built 42,000 kilometers of high-speed rail. It constructed hundreds of entirely new cities. It built ports, highways, airports, and power grids at a pace that had no precedent. The third driver was the Chinese household savings rate, historically between 35 and 45% of income, compared to 6 to 8% in the United States. That pool of domestic savings provided the capital fuel for investment. And the fourth was deliberate currency management. For decades, China kept the value of its currency, the yuan, lower than free market forces would have placed it, making Chinese exports even cheaper in foreign markets and extending the competitive advantage of the China price. Now let us be completely honest about what this model produced, both the genuine benefits and the real costs. The benefits for consumers in the United States, Europe, Australia, and Canada were enormous and lasting. Your laptop, your smartphone, your television, your clothing, your furniture. All of these goods cost substantially less than they would have without China's manufacturing capacity. Some economists estimate that Chinese manufacturing suppressed consumer price inflation in the developed world by as much as 1 to 2 percentage points annually for decades. That is not a small number. Over a lifetime of purchases, it represents tens of thousands of dollars in purchasing power that ordinary households in the West retained because of the China price. For investors, the growth of the Chinese economy and the corresponding growth of its consumer class created decades of return opportunity. Companies that established operations in China or that sold raw materials to feed China's construction boom, iron ore miners, copper producers, oil companies, generated strong returns for their shareholders. But the costs are just as real, and they deserve equal weight. The most direct cost fell on Western manufacturing workers. The same China price that gave consumers cheaper goods made factories in the American Midwest, the industrial Midlands of England, and the Ruhr Valley of Germany uncompetitive. Jobs did not disappear gradually. In some regions and industries, they disappeared rapidly. The economic disruption was real, significant, and geographically concentrated in communities that had organized their entire economic identity around manufacturing. This is not an abstract trade statistic. It is one of the most consequential economic disruptions of the last 30 years, and its political consequences. The rise of economic nationalism across Western democracies are still unfolding. The second significant risk is debt. China's growth was partly financed by enormous borrowing, concentrated especially in the real estate sector, which at its peak represented roughly a quarter to a third of Chinese GDP. In 2021, Evergrande, one of China's largest property developers, disclosed $300 billion in liabilities. To put that in context, $300 billion is larger than the entire annual economic output of Portugal. And Evergrande was not an isolated case. Dozens of other developers carried similar debt structures, and the financial stress created by this concentration of borrowing is still working through the Chinese economy as you watch this. The third risk is demographic. China's one-child policy, maintained from 1980 to 2015, dramatically reduced birth rates. The consequence is a workforce that is now shrinking while the elderly population grows. Fewer workers supporting more retirees at exactly the moment when the economy needs maximum productivity to service its debt. This is a structural challenge that cannot be quickly solved by any policy. And the fourth risk is geopolitical concentration. The COVID-19 pandemic made visible what supply chain experts had been warning about for years. When the world's manufacturing is concentrated in a single country, any disruption to that country creates global shortages. The chip shortages, the shipping delays, the empty shelves of 2020 and 2021 were all downstream effects of that concentration. So what does all of this mean for your financial decisions right now? If you hold index funds that track global or emerging markets, which most long-term investment advisors recommend as part of a diversified portfolio, you almost certainly already have exposure to Chinese companies. The MSCI Emerging Markets Index, which many international funds track, carries significant Chinese representation. Understanding what you own and why matters. The key principle that China's story teaches investors is the importance of diversification, not just across asset classes, but across geographies. China's rise created genuine opportunity. Its risks are equally genuine. The appropriate response is not to avoid it or concentrate in it, but to be informed about your exposure and balanced in your approach. For your broader financial life, the lesson is context. Your grocery bill, your mortgage rate, your job market conditions, the prices you pay for energy, electronics, and everyday goods. All of these are connected to what happens in the Chinese economy. Not indirectly, directly. Chinese demand for commodities influences oil prices. Chinese manufacturing capacity influences inflation rates. Chinese government investment decisions influence global bond yields. The interconnection is deep, ongoing, and worth understanding. The three things to take away from this are simple. First, China's rise produced real and lasting benefits for consumers in the developed world that are easy to take for granted and important to recognize. Second, it produced real and lasting costs for specific communities and workers that are equally important to acknowledge. And third, the risks ahead. Demographic, debt-related, and geopolitical mean that China's extraordinary growth rate of the last 40 years is unlikely to continue at the same pace, which has implications for the global economy, your investment returns, and the cost of goods going forward. Being a better financial decision maker is mostly about understanding the context you are operating in. And in the economy of 2024 and beyond, China is unavoidably a central part of that context. The miracle happened. Understanding it fully is how you make it work for you, rather than simply being subject to it.